India has produced 187 new billionaires in the past 1 year. The 2023 M3M Hurun Global Rich You're with us here on Bttv. I'm Abha, Bakaya. Let's take a look at how markets are doing this afternoon. It's Friday. We're heading to a close of an eventful week. We had the Fed rate hike as expected. They do seem to have taken into account worries about banking collapse in the US, but still didn't prevent them from that 25 bips point. Today, markets are down 350 odd points on the Sensex, Nifty down 120 points, so below 17,000 once again. It's been a choppy week, and it looks like we're closing on the lower end of 17,000 and 58,000, well below the 60,000 mark on the Sensex, in fact. Dhananjay Sinha is joining us. Let's go across to him and get a perspective from him as well, head of equities, and get a sense of where he feels the markets are headed. Dhananjay, is it very easy to really predict a pattern right now, given how volatile markets have been, and given that none of the indicators are really giving us a clear sense of the direction from here on?
Right. I think the year started on a positive note. We were expecting that the market was expecting at least that the opening up of China and the expectation that there would be a sort of a dovish tone of global central banks, including the Fed and other major economies. The year started on a positive note. So basically, China-led recovery and valuation been supported by a dovish central bank scenario. I think things have actually changed significantly. So there has been a lot of shift in views around what the Fed would do. So eventually, Fed came around saying that inflation is high. We need to be hawkish. We need to keep the rates high, maybe higher than what they initially thought. And then you had this banking crisis. So I think the markets have been yo-yoing, within this whole range of views that has happened with respect to the central bank. So we have this whole banking crisis happening in Europe and also in US. So I think the markets basically, if you look at the futures market, the market still expects that by end of this year, the Fed would actually do rate cuts of roughly about 75 basis points. So there is a sort of a benign view, and there does seem to be a sort of a climactic tug of war that is happening between the central banks and the markets. We have seen ECB, BOE, Bank of England and Fed, all of them brushing aside the risk of the banking sector disturbance translating into a contagion. So all of them are saying that this is kind of a problem with a small set of banks, and the concern on inflation continues to be high, and hence they have actually gone ahead and done rate hikes. All three of them have gone ahead and done rate hikes. So I think there is a hawkish view that central banks have taken, and markets are actually expecting a dovish capitulation by the central banks. I think that's where it is. I think from a fundamental standpoint, we all know that there is a slowdown that is happening, and there is a dichotomy within the Indian corporate performance, wherein we are seeing sort of a scaling down of operations, sales, raw material consumption, etc. has been happening. If you look at the results of non-finance companies, and banks have actually been doing fairly well with respect to the earnings data that they have announced till the last quarter. But I think the concern now is that as the slowdown continues, there will be a sort of this outperformance of the banking sector will also not sustain. So I think it's a kind of a tug of war on the liquidity part and the valuation part, and the uneasiness with respect to the earnings trajectory going forward. So my sense is that there might be a sort of a volatile scenario going forward, and the bias is more on the downside than upside. We'll need to see how it pans out. So our positioning is sort of conservative within the overall asset allocation that we have done with respect to our portfolio.
Interesting. Okay, a lot of these new taxes today. Let's talk about that. We've got STT hiked, and this is what the government does now, right? We think we got away with it during the budget, and then soon after budget, we'll start to see the series of mini announcements. But what are you making of the slew of announcements around taxation?
So I think that the macro picture, what appears to be happening is that you are coming after the last year has been pretty strong with respect to the tax collection. I think the overall gross tax collection that the market that the government had actually put out is somewhat higher than what they thought initially. So it's somewhere around 13.5%. And so I think what is happening is that since many of these tax items are actually peaking out and there is a slowing of growth, we know that corporate profits are actually slackened. So I think the worry is about the rising debt scenario, expenditure being on the higher side, and the fact that your buoyancy in taxes might not eventually pan out. So I think what the government is trying to do is to really plug those loopholes, especially in the context that people, especially the HNIs and people who have made money in the market, they're trying to see how we can actually take some taxes out of it. So I think with respect to the debt mutual funds, where a lot of there is a sort of a tax arbitrage between fixed deposits and the tax and the debt mutual fund that has been there. So I think the government is saying that the tax arbitrage that is there will remove that. This way by this they can actually increase tax collection. And I think they are doing this with respect to the FNO transactions as well, where again here there is a lot of transactions happening. A lot of people are making capital gains out of here. So I think the government appears in principle moving towards a scenario where they would actually start taxing more or sharing or imposing a little bit more tax burden on the guys who are actually making the guys who are actually rich or wealthy guys. So I think that's the broad context that is there. So I think there will be certain rejig as far as the mutual fund schemes are concerned. The debt mutual funds will be more like will convert into a sort of balanced fund, or hybrid fund will come around that will gain flavor going forward. But by and large, the government is trying to extract more taxes from the wealthy people in the economy.
Okay. What are you expecting from the Fed going forward? Because, they've kind of talked about how they might take into cognizance the current weakness in the economy. But, but we still saw a hammering on the banks overseas.
Yes.
What are you making of the cues from the Fed?
So I think what the Fed is saying is that you have a sort of a problem with respect to a certain small set of banks, and they have in their communique they have said that at a broader level the banking system remains pretty robust. So I have also looked at the numbers and all. It does look like the capital adequacy in the US banking system is fairly high. So the overall capital is about 14.6% as of December quarter, which is a fairly robust number compared to the pre-GFC or pre-subprime crisis. So I think from a capital adequacy level, there's good amount of liquidity, good amount of sort of counter-cyclical buffer that is there. And I think the smaller banks are little higher in terms of capital adequacy. They are around 16% and higher. So I think the capital buffer is there. Secondly, I would say that the banking system liquidity in the US is about $3 trillion in excess. So the amount of money that banks have put with reserves as excess money is roughly about $3 trillion or thereabout. And I think the money supply to GDP is still fairly elevated at 81.6%. So it is down from 90%, but it's significantly higher than 69% that prevailed prior to the COVID. So I think there is good amount of liquidity, good amount of capital that is there. So I think what the Fed is saying is that we are not too worried about it. The current counter-cyclical buffers are good enough to take care of it. Large banks are fairly diversified in their risk distribution and all. So they are not really seeing this as a systemic problem. If that is the case, then I think they have continued to focus on the objective of inflation management and price stability, which is why they have kind of been more dovish than more hawkish than what the market is expecting. Market was expecting at least that they would sort of be more dovish, if not hit a pause button. But I think the Fed has been fairly hawkish from that standpoint. What it is saying is that if these banks, small set of banks, do not create a credit risk at the broader level or credit crunch at a broader level, they're fine with raising rates. So I think what is very central to this whole communication, both by the Fed and by ECB and other central bank, is that they would sort of continue on the tightening path as far as financial conditions are concerned. It can come from higher rates or it can come from credit crunch through the banking system. But any which way, the central thing is that the financial conditions need to tighten such that the inflation control is the objective of price stability is achieved. So I think broadly, I would say that the central banks have been in consonance with this whole trajectory that they need to tighten financial conditions. So I think I would consider it's kind of a hawkish scenario as far as the monetary policy conditions are concerned going forward. It can be closer to the peak level of rates. They may increase rates and keep it at that level for some time before inflation is controlled. So I think from a global liquidity standpoint, to sum it up, and from an India perspective, I would say that the flows from global standpoint and global surplus liquidity may be narrowing going forward. So I think Indian markets will significantly be dependent on domestic flows, be it from HNI or promoter-led funding or the mutual funds. I think that's where the situation will be from a flow standpoint, I would say.
All right. In terms of specific segments of the market, how are you looking at asset allocation right now, Dhananjay? Are you being cautious? Are you sticking with some of the frontline names? Are you looking at things as value buys right now? What would be your advice?
So I would say that eventually
Sorry.
we're looking for some capitulation. So if you look at the Indian markets on a valuation basis, it is one of the expensive market in the world. So I've done comparison against 26 major indices in the world, and we would be about 40-50% higher than the global average as far as price to earnings ratio is concerned. So that is one. So the expectation is that your earnings will be pretty strong. The consensus expectation is about 15% growth, 18% growth in the next couple of years. I think the risk to that is fairly high, and hence the valuation is at risk, according to me, in the entire pecking order.